Plan B is the market leader in the growing industry. Now, it's time to switch on the lights of the billboard and initiate the buy recommendation on Plan B as our Plan A, ladies and gentlemen. With a target price of 9.15 Thai baht, representing 14% upside, we recommend buy based on 3 reasons. First, the return of out-of-home media from tourists. Second, expanded margin from the past acquisition. And third, strong management team securing the prime location in upcoming events. Most Thai people and tourists may used to face a lot of commercial billboards in Thailand. One of them would be Plan B's product. Plan B is the leading company that offers the out-of-home advertising channel in Thailand. In 2021, 70% of their income generated from out-of-home media business. They have both static billboards and digital screen everywhere outside. For another main revenue stream, it came from the investment in sport and artist management business. It leads to the recurring income and synergy to the main business. In recent years, Plan B also engaged in the ESG initiative to sustain their business operation toward all stakeholders' benefit. Those can be ensured by the scoring from both local and international organizations. The most standout dimension here was governance because of the transparent company structure. To protect the minority shareholders, they had 1/3 of independent board of directors and the declare of the conflict of interest between the strategic shareholders. Moreover, we expect the monitoring effect and low agency costs from the 24% holding of the financial institution. If you take a look on the bigger picture of the industry, the market before the pandemic was growing continuously with only a few key players. It's led to the market consolidation. Acquisition happened for 4 times in only 3 years. Meanwhile, Plan B got more strategic shareholders during the period. Next, my team will elaborate more why we gave the buy recommendation on Plan B based on these 3 reasons.
Thank you. Out-of-home media in Thailand are returning from the resurgence of tourism, supported by 2 arguments. First, more potential eyeballs from the returning of tourism. Second, FMCG will increase their advertisement spending from the improving economy. Starting with the first one. Out-of-home media in Thailand are highly correlated to the number of tourists entering the nation. Consequently, as tourism in Thailand are returning to its pre-pandemic level, we expect out-of-home will be bustling. This is because we believe that in 2023, tourists will enter Bangkok area as high as 26 million people, increasing the overall potential care supply to over 37 million people. Secondly, since out-of-home media will gain so much more exposure, multinational FMCGs or fast-moving consumer goods will leverage from this. Currently, 36% of Plan B clients' portfolios are multinational FMCGs that would like to gain exposure to not only locals but also international visitors. Furthermore, with the improving economy, rising the private expenditure index to 143.5 index point, we believe that locals will spend more money on necessary items from FMCGs, and in turn, FMCG will increase their advertising spending. However, this begs the question, does Plan B have the capabilities to capitalize the return of tourism?
Thank you. And to answer this question, we draw an analysis on the perspective of Plan B. And we see that this is the exact time to reap the benefits from past investment, and the operating leverage will amplify this effect. Plan B has aggressive investment over the past years with 2 major acquisitions. This has ramped up the media capacity to 1.4 times, indicating ability to double its revenue without investing more in media capacity. We anticipate this trend to continue and ramping up the utilization rate to 69% in 2034. Moreover, if we take a look at the cost analysis, we could be able to see that 70% of it are fixed costs. We anticipated this cost to be level over the forecasted period, and this is why we believe that the profit margin will be expanded as a result. These 2 things are the main reasons why we believe that Plan B has the ability to capitalize on this opportunity. The question remains, how can we sustain it? This leads us to the next investment thesis, that the market has underappreciated this strong management team that has been able to secure the prime location and events. There are three supporting arguments to this. They are the leading out-of-home media players. Secondly, they are conquering the prime locations. And lastly, they have consistency in finding new events. Plan B has witnessed many market consolidation over the past years, ramping up its market share to 37%. This is as a result of other key players are selling its out-of-home media business to Plan B. And we anticipated this trend to continue and the market share will be expanded to 52% in 2028. Moreover, as we believe that the prime areas are the strategic locations to out-of-home media business, we anticipated and raw analysis on the 10 most congested roads, and we see that Plan B is in every single one of these roads. Not only roads, but also the tourist attractions in Thailand that will attract millions of international and local visitors. And zooming onto the big pictures, we can also see that the upcountry has been dominated by the Plan B reward as well. Lastly, this green management team has been able to build one business unit from scratch, starting from the zero of revenue contribution to 27 revenue contribution in only just 6 years. And this investment is the engagement marketing. This is a solid proof that Plan B is in the leader position in every single business that they have been invested in. This has given us 3 key takeaways: that the profit margin will be expanded alongside with the market share, and we also believe that the engagement marketing will be able to recur the revenue. The question remains: is the price right now just right?
We project the Plan B revenue to grow 6% per annum under the recovery phase and the growing phase under the drivers of first, the out-home index expansion, and second, the increase in immediate capacity from strategic acquisition, and third, the utilization rate increase from the strong economic recovery. And furthermore, we also project the margin expansion due to the first driver of the operating leverage, which gears the margin with respect to the sale, and second, the price premium, which can be has more marketing power from strategic acquisition and the innovations offered to the customers. And also, next, with the discount rate of WACC 9.11% and the terminal growth of 4%, we arrive to the target price of 9.15%, representing the 14% upside, and this is supported by the sensitivity analysis of different terminal growth and the WACC of Plan B. In addition, the football field analysis indicates that the DCF valuation price is in line with different valuation methods, and PE ratio average and the PEG ratio also confirms that the price is currently undervalued.
For the last part of these presentations, we have conducted a bulls and bear case analysis. In our bull case, we determined the price of 11.36 higher, a 41% upside, in which Plan B fully utilized the synergy between Marcos and Aquas. Our bear case suggests a 13% drop from its current price. However, we believe this case is highly unlikely. For the investment risk, we have identified 2 of our greatest concerns. Starting with the first one, unrecovered economic activity, which can be mitigated by a well-diversified asset portfolio of Plan B. Next, the key man risk, which also can be mitigated by a successful plan for management team. The other risks were either low probabilities or low impact. We therefore restate the buy recommendations based on benefits from rise of our home media, the margin expansions, and lastly, the best management team securing the long-term goals. For investors looking for the market leader in a growing industry, Plan B is the best investment decisions. Thank you. Now the floor is open for Q&A.
My first question would be, how much revenue is derived from the tourism-related advertising for Plan B?
May I take the questions? Okay. So from our first thesis, we think that the out-home advertising expenditures is highly correlated with tourism. And with the increase in tourism, we expect the same growth rate to increase our home media advertising expenditures.
Let me add on to my further colleagues. So the utilization rate is increasing relative to the increase in the tourism in Thailand, as there is the announcement in the Q3 in the 2022 mentioned that there is the growth of tourism coming in Thailand, and this drives the utilization rate increase for the operation of Plan B.
And I saw your terminal utilization rate at 69%. Why it's not come back to the past peak like 70+%? Why do you think that 69 is appropriate?
Okay, allow me to address on this question. The reason why we believe the utilization rate to go up is not because of so the utilization rate are coming from the revenue divided by the media capacity, and we believe that the media capacity has increased for 2 times in the past year. So this is why we believe that the utilization rate will be increased to the certain point where the revenue has been forecasted. So as a result of the base, it's actually getting a lot of higher. So we have a conservative view on the utilization rate to ramping up.
From what I understand, you use the discount cash flow as the single valuation model for target price, right? Why you're not using PE ratio?
Currently, we use the multi-stage free cash flow to firm to reflect what Plan B can use the leverage the position of acquiring different business. So the free cash flow to firm would reflect best as there is a greater time frame, so we can have more value as we can see in the different period timeline of up to 10 years. And this will reflect in the terminal growth of 4% derived from the long run 10 years of our home ADX growth. And we try not to use, we not prefer to use PE ratio, since it is the price which market sees from the earnings of the company, but we still see the potential upside from the operation of the company instead.
You said that the company would be able to command a price premium in the future. Why would that so?
Okay, allow me to address on this question. The price premium that we could be able to negotiate is because of we are conquering the prime locations and the strategic locations that we believe to be the value proposition of the out-of-home media business. So as Plan B will be the only player who can be able to have a billboards at the prime areas and prime locations. So we believe that this is a bargaining power to increase the price premium.
Not only that, but also Plan B are operating in Bangkok areas, and they acquired most of the billboards in Bangkok area already. And with this, brand will spend more money from the Plan B asset that it has, that is populating the Bangkok area.
My follow-up question would be, can the premium value you mentioned, can it spill over to the landlord? And what is the lease agreement between Plan B and the landlord like Siam Paragon?
Most of the lease contract is like 3-year contract, and we also agree that if the prime location is the key, that Plan B can rip up the high price, so the landlord also jack up the lease cost. And we also reflect that in our risk, which landlord can increase the price, and the result will be reflected in our bad case scenario, which will reduce our price.
So your best case is the landlord will not jack up the price.
Yes, we have also, we're looking at the past history of Plan B, and Plan B can manage the rental expense cost in the same ratio with media capacity. So we think that management team have expertise in controlling the cost of the lease payment.
I would like to add on to my colleague. We believe that with Plan B expertise in our home media, with the landlord increasing too much of their price in the billboard, we believe that it will negatively affect the landlord itself. And we believe that the landlord will increase the price of the lease agreement to only a certain point that will not affect Plan B that much. That's all.
Why increasing the price from the landlord will be negative for landlord? Because the prime location is prime location.
So if it increase the price of the land too much for Plan B to we enable the contract, Plan B will look for other strategic location instead and maybe negatively affect the land.
So when you value the company, you really look in the long term, and I think you assume that this company will acquire more companies. So, but right now it seems like the company has very secure prime locations like Bangkok and big cities. What are the future opportunities that you see in the small city? Is it what you see?
Actually, from our investment thesis, we do not expect the company to acquire more and more location or the other company anymore. We expect the company to utilize the asset that they have in the base case, and we believe that without more investment in these 3 years, the company can gain the bottom line more than the past from the higher of media capacity during the pandemic.
Okay, so you're not really assuming the company will acquire. 4% terminal growth rate to me seems to be high. What is the rationale behind that?
Currently, we derive the terminal growth as we have seen the announcement from the MD&A and see that the revenue of Plan B is relatively growing to the out-home index growth and the year of tourism growth in Thailand. And we see that the 16 years in the period of growth in the out-home index is relative to 4.2%, while the tourism in Thailand is growing in the pre-pandemic is about 9.59%, and we see that the 4% terminal growth rate is reasonable enough to plug in the terminal growth input because Thailand there is a dense population of tourism and domestic people coming in Thailand and having the traffic around the capital city, and we see the Plan B can reap the benefit from this growth.
Sorry, for the 16-year out-of-home growth is a forecast or is it?
It's the historical growth, and yes.
In your valuation, how much value come from the out-of-home business and how much is come from engagement marketing?
We didn't derive the DCF model from SOTP. However, we summed the revenue and cost into the single model. But in terms of revenue contributions, can you show this slide? We expect the conservative case of engagement marketing and use conservative rate revenue growth of